In today's video, I'll be talking about investing and time. We are going to look into what the impact is when you invest for 1 year, 10 years, or 100 years. I'll talk about the 3 key factors that determine if you succeed in investing or not, which factor is the most important to focus on, why me and probably you do not focus on the right factor. I'll explain a rule that can help you do the maths in your head very quickly, the rule of 72. Show you some scenarios which I think a lot of us are in. Oh, and lastly, if you are wondering why I look at 100 years, I'll explain towards the end. As always, this is not financial advice. These videos are for educational purpose only. Please do your own research before you make any financial decisions. Subscribe to the channel. There are some good stuff coming out, and like this video to help us reach as many people as possible. Okay, let's jump into the video with topic number 1. What are the 3 key factors that drive the size of your investment pot? Factor number 1, your starting capital. In investing, size does matter. A 10% return on a £1,000 portfolio is £100, whereas a 10% return in £100,000 portfolio is 10k. The larger your capital, the higher the impact from the returns, as we can see from these 2 bar charts here. Factor number 2, returns. This is an obvious one. The higher the returns, the faster you can increase your capital over time. And lastly, factor number 3 is time. The longer the time horizon you have, the more years you allow for compounding to take place, which has disproportionately larger impact as time passes. Now the question is, which factor do people focus on the most? The answer is return. People are chasing the next multi-bagger, the next Nvidia or Palantir. How many times did you come across someone that said, I am an early buyer in so-and-so, or I bought when this stock was trading at $10 and now it's trading at $1,000? I came across many. I am sure you did too. But what if I told you that this is not the most important factor that people should be focusing on? Time is the most important factor. It is the only thing that when it's gone, and it's not as exciting of a factor, so people don't talk about it or don't focus on it. You won't hear someone saying, I became a millionaire because of time. It's unheard of, but in my opinion, it's the most important thing you should focus on. We don't focus on time because 1, it's not exciting, and 2, our brains are not designed to comprehend the impact of time when it comes to compounding. Let me explain. Let's say you have £10,000, dollars or euros to invest. You choose a passive exchange traded fund tracking the S&P 500. This fund tracks the largest 500 companies that are publicly traded in the United States and historically returned 10% per year. If you invest your 10k for 1 year, you will end up with 11k. You made 1k. If you invest the same amount of money for 10 years, what do you think you will end up with? You will end up with 26k. You made 16k. Now, how much do you think you will make if you invested for 100 years? You will end up with £138 million. Did you notice as well that your brain cannot work out what gains you will make as time expands? The rule I'll talk about later on will help you do that. Now I get it, 100 years is a stretch, but just think about this. If you invested 10k today, then your grandson or granddaughter can end up with 138 million stock portfolio. It's baffling. More of that in a bit. Let's get back to time. The actual time or timing of your first investment is something you can control. These days, you can start investing with very little. So I think in investing, it is important to focus on the things you can control. It's almost a way to set yourself up to enter this mental state that improves the odds for you to win in this game. Focusing on time and studying what happens over time in the stock market is helpful. It helps you be ready when things turn ugly, and that's where money is made. When the markets drop, that's when you need to remain invested and not panic. I can't stress this any better than the legendary investor Peter Lynch. So let's check this video where he talks about market corrections.
So I think that's, but you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know.
So every 2 years, the market falls by 10%, and every 6 years, the markets will drop 25%.
You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. So I think that's the key element. Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor. You're not sure this Walmart can make it. You want to check. You see them operate in small towns. You're afraid they can only make it in 7 or 8 states. You want to wait till they go to more states. You keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money.
And I guess another key point from this video is that no one knows when these corrections will happen, and you have plenty of time. So focusing on time for me is key. Understanding historically what has happened, it means you understand that corrections are part of the game and know how much time you might need to get out of these corrections. Knowing this and being comfortable with it increases the chance you remain invested, which means you have higher chances of winning in this game. Looking at this Fidelity paper, you can see that the best return comes when you remain fully invested. If you miss 10, 20 or 30 of the best market days, your returns are materially impacted. So how do you make sure you remain invested? Study what happens over time in the markets and focus on your time. If you do that, you will be in a state of mind that will improve the odds for you to win. Now, I get it that we are all at different stages of our lives, have different starting capital, returns and time horizons. A way to help you understand how money grows is the rule of 72. This is a simple rule that can help you quickly calculate with how much money you will end up with. The rule needs the 3 factors I mentioned earlier. 1. Starting capital, 2. Return, and 3. Time. The steps to the rule are as follows. Divide 72 by your expected return, divide your investment horizon with the calculated number, and then this is how many times your starting capital will double. Let's go through an example. Let's say you have 10K as a starting capital, your expected return is 10%, and your investment horizon is 35 years. So in our case, divide 72 by 10, which is your expected return, to get 7.2. For simplicity, we'll assume 7. Now divide your investment horizon with number 7, which means you will get 5 doubles. Your starting capital will go from 10 to 20 to 40 to 80 to 160 and then to 320. These are 5 doubles over the 35 years. Let's try another example. Let's say you have 10K as starting capital, your expected return is 7%, and your investment horizon is 40 years. We take the 72 and divide that by 7 to get 10.3. We remove the 0.3 to help us with the math. We divide our investment horizon by the 10 to get 4 doubles, which means our starting capital of 10 will double 4 times to £160,000. Another way to think of this is if you have saved 4 doubles, this means you can multiply your starting capital by 2 to the power of 4. This is the equation here, which is 10, your starting capital, times 2 to the power of 4, which will lead you to £160,000. Hopefully you get this rule. It's pretty simple. You divide 72 by your return. This is the number of years your money needs to double. And then you divide your investment horizon with the years your money needs to double. And you have the number of times your money doubles. Then either do the 2 to the power of how many times your money doubles, or go through the motions of 10 becomes 20, becomes 40, etc. The last point is this. 100 years as an investment horizon is a long way, but 10K invested today for you or your family can change lives, can even change the direction of your family tree. The point is start early, focus on what you can control, which is time, and if you think you are late, we are all late. The best time to start investing was a year ago. The same will be true a year or 5 years from now. That's it for this episode. If you found this useful, like the video and subscribe to the channel, and I'll see you in the next one.